All right, cool. So 3 or 5, I think if everyone's good, we're going to get things kicked off. Um, like I mentioned before, we're going to have the hashtag community chat open. So if you have any questions throughout or just generally want to kind of share different things that you're thinking about or where you're calling from, feel free to have the community chat open on the side. I'm Eli, and welcome to this week's MCJ community chat on ESG investing. Before getting started, I just want to give a huge thank you to Chris Powers, Brianna Miller, and Daniel Ernst for helping organize this. Nicole Kellner was also very involved in helping organize, but unfortunately couldn't be here today. But in normal settings, I would love to give a round of applause, but little silent thank you for all the people who helped put this together. Thanks, everyone. For anyone who hasn't been to one of these community calls, we host them every 2 weeks. It's kind of an amazing space to not only hear about really interesting topics like ESG investing, for example, that MCJ community people are interested in, but it's also just a great way to meet everybody in the community. Obviously, Slack is great, and there are lots of conversations that come from that, but just having some time every couple of weeks where people can come together and just see everyone's face and get involved in the breakout rooms is just a really nice format. For the agenda for today, we're probably going to do around 30 minutes of panel discussion, followed by 2 50-minute breakout rooms. Those times are give or take depending on how all the discussion is going. I think both the panel and the breakout rooms are equally exciting, so sometimes it's hard to pick which one to prioritize. Cool. So with that, today we're joined by an amazing panel. Very, very excited for all the awesome people that we have today. We have Daniel Ernst, who helped also organize the panel, so huge thank you to him from Purchase Par Capital. We have Sophia Purdom, who has a to-be-announced carbon offset fund. Hopefully we'll get to hear a little bit about that, but I'm sure it's in the works still as well. And Monica Varman, who's a returning panelist and an investor at G2VP. Unfortunately, Karen wasn't feeling well, so she couldn't join us for today's panel, but we're still very appreciative to her for offering to join and hope that she'll be getting better soon. Just quickly before we start, since we had some people join, like I mentioned, we have the hashtag community chat open. So feel free to join that to have discussions with everyone. I think generally during the panel, people keep their mics muted just to lower feedback, but we love people having discussions and being involved, and you can kind of do all of that right in the Slack channel. We are also recording this call, so if anyone feels uncomfortable for any reason being on the call, you can always change your name and mute yourself if you want to stay anonymous, but the breakout rooms will also be recorded. The way Zoom works, it's only going to be the breakout rooms that Chris Powers is a part of, so if you're not in a Chris Powers breakout room, you can feel comfortable with being in stealth mode. But if you happen to get him, stay on your toes. So with that, again, huge thank you to all the panelists who joined us for today. And I'd love to just kick things off and get right in. So this one is for all of our panelists, but obviously ESG is a ever evolving space and there are many approaches to its use and its definition. Could each of you kind of start with just providing your overall perspective on what ESG means to you and how you employ it?
Sure. Want me to, is there an order you have in mind, Eli, or?
I think let's start with you.
Sure. So I'll preface that question by saying I don't think there is anything called ESG investing. I think ESG is a tool that can enhance investment, but it's not per se an investment strategy. So let me walk you through 4 ways that I tried to think about ESG and ways to employ it. So the first is from secular change. So I spent most of my career focused on technology-driven secular change. So I started as an economist building wireless spectrum auction models in the transition from landline phones to wireless, and then as an investor and an analyst looking at everything from e-commerce and the transition from bricks to clicks, and in media from cable TV to streaming, and in computing from on-premise licenses to cloud-hosted software as a service, and all of those things. The early in the cycle, you had both incumbents and investors kind of doubt what's going on. Early in the cycle, the signals that will allow you to understand those changes, those behavioral changes, those technological shifts, would not show up in an income statement or balance sheet. And so it's easy to ignore because they're not that material yet. And at the core, what ESG analysis is this process of trying to understand these non-financial metrics, or rather these metrics that might become financial or material in the future. And in all those transitions, tech was an enabler, but not necessarily the thing that made it take off. It was more a business model shift. And so my second point is that if you look at climate change, there's a lot of similarities to the digital disruption in climate change. You're sort of starting with doubt, right? Because you can't see and feel it today. And so you tend to, over discount it. That's sort of one large thing that happens. And the process, the business model shifts, sort of want to also doubt how you could do business a different way. And so the third thing that way I look at it is that I fundamentally believe that companies which prioritize their workers, their products, the community environment around them, ultimately produce a better product to gain market share, which ultimately leads to higher financial returns and therefore better market valuation. And that process of valuing all the stakeholders, I sort of look at it as a flywheel. And so that is ultimately that sort of prioritization of people, planet, and profit is sort of what ESG analysis can sort of help you uncover in the process. And then the fourth point I would make, sort of the way I look at ESG, is that if you look at public markets, there aren't that many pure plays. Like ultimately, if you want investments to influence how the world operates and how the climate is, you're going to want, I think, there to be profitable leaders to sort of demonstrate, there's a different way of doing business. So you want them to succeed. Unfortunately, we don't today really have what I call a FANG for climate. There's no Facebook climate, there's no clear winner. There is like companies like Vestas and Ørsted and Tesla, I call them Volt, but there aren't that many of them. And so we need more. And that's one of the reasons why I actually really like this MCJ community for me, because I would say most of the activity that we see here is on the venture and private side. We need this innovation to happen in order to create climate. So we need to create these new winners to demonstrate the financial benefit of valuing these other factors. So those are kind of the way I look at ESG.
Yeah, that's a really similar way to how we think about it. So I work at G2VP, which is a venture fund, and for us, we see E as the tip of the spear. So E is primarily for us how we think about our portfolio companies creating value. Either they directly advance environmental sustainability, so Proterra, for example, makes electric buses, or they enable the advancement of sustainability. So they're like infrastructure for getting food to people faster and just disintermediating food supply chains to reduce food waste, for example. For us, the S and the G tend to be a little more of an enabler or a risk mitigation piece. So on the S side, our companies are small enough that, and often technology companies inherently don't have as much direct labor or gap in the ratio of executive to frontline worker pay. So the S piece tends to be a little less relevant and is mostly driven by our set of LPs who do ask us questions like how many women we have on our boards, for example. But G we see as being kind of table stakes. So we need good governance at all of our companies. It is more of a risk mitigation strategy than anything. Like well-governed companies are often well-run companies in that when things are not going well, you have the processes in place to help the company survive and thrive through it. But yeah, each of these is slightly different for us in that E is like very actively value creating and the S and the G tend to be more of risk mitigation.
Can I run with it real quick? Run with that question too? Add a little context? Awesome.
Absolutely.
Fantastic. I think it's important to almost take a slight step back and understand how ESG fits in the historics of what I would more broadly classify as sustainable investing. And argue with me, panel, please, but I see there being kind of 7 tribes, if you will, and I won't walk through all 7 because we're cognizant of time here, but the ones that are most relevant, I would say, to ESG would be mission-driven investing, or values first, values, right? So this idea of there is a double bottom line impact that you're trying to attain, you invest to attain that. The close follow-on of that, but different approaches, even though similar words, would be value first. And a good example of a value first would be generation investment management, where broadly, right, there's 2 monsters that you're trying to satisfy at once. One, your thematic or mission, so environmental primarily, as well as your very sound traditional investment thesis. And you have to have both. The third would be impact investing broadly, which I would try and kind of define more tightly as location or kind of group focused rather than a broader mission. So it's often pretty geographically targeted. And then also adjacent to ESG would be, so think targeting renewables, right? And then the other 3 would be integration, so kind of broad conceptual ESG data, probably for a much larger asset owner. Shareholder engagement should not go understated either as a driver of sustainable investing. And then lastly, a slightly more European approach, the minimum standards, right? So you see this like aligning with lots of the UN goals. So 7 plays, different groups, glad we're all here. Within that, I would agree with Dan and Monica that ESG is very much a data-driven, most adherent to kind of like the traditional due diligence set. You're looking at slightly different parameters, but it's only really relevant, in my opinion, if you're tying it explicitly to materiality. And so to be a good ESG investor, what matters? And that's very dependent on size and industry. And so you've got to really pick your metrics appropriately. Otherwise, you're going to be looking at how much paper a year does an oil and gas company use, and that's probably not going to get you to your ultimate goal.
Amazing. Thank you so much. It's so great to have kind of a diverse panel that has all of these different perspectives in mind. And I think that's very indicative of ESG in that there are lots of different ways to apply it. And it's great to hear from all of you on what that means to you. I think something we got a lot of questions around and have seen a lot of conversation around in MCJ is like ESG is definitely something that feels like it seems to be growing. How would you all kind of go about thinking how to quantify that growth or how you've seen it in your own industries?
So I'll give you 2 answers. One is how it's kind of measured today, which is there's kind of like a few different numbers out there. The Global Sustainability Investing Alliance pegged it at around 30 trillion at the beginning of 18, growing 34%. So that puts it at like 40 trillion today. There's 300 trillion in global financial assets. So yeah, it's growing, but it's not everywhere. Then there's the UN Principles for Responsible Investing, the UN PRI, and there's something like 80 trillion of assets represented at institutions that have signed the principles for responsible investing from the UN. So, but if you look at that, you say, okay, is there really 80 or 90 trillion of assets like, you know, trying to solve the world's problems today? That's my second answer, is no. And so I think that the next level down, some other questions that sort of get to this, the next level down analysis in all of this is how much of this is sort of impact oriented. And historically, impact meant something kind of different, like, you know, you're working on community farms or building affordable housing. But if you're really trying to have like an outcome out of your investment, like how much this is really having, you know, outcomes driven investment, it's probably not 80 trillion.
The way I'd see it is there's been a lot of interest in ESG investing, and so a lot of even retail investors and the corporate millennials looking to put their money behind ESG related ETFs, but a huge diversion in how it's actually executed and what that means. And so ETFs rely on information that's released once a year. We have very little information in between sustainability reports. And although there are frameworks like SASB, which are trying to create like a GAP or IFRS like infrastructure for ESG metrics, there isn't the same enforcement or punishment, I guess, for reporting that information incorrectly in the way that you have for financial information and financial fraud. And so people are basically executing it in different ways. In some cases, I think investors are using it more as like a marketing label to draw more capital to an ETF or to an investment product, which is unfortunate because I think inherently, I do believe that the ESG framework, as Daniel had said earlier, is a helpful framework to judge how resilient a company it is and how strong it is. And it is a good indicator of its fundamentals and its ability to attract customers and employees. And so if implemented well, I think this interest will draw more capital to more resilient companies and resilient securities.
I'd echo that and say right now adoption is high, quality is relatively low. There isn't a standard necessarily to follow, although there are some frameworks out there, SASB, CDP, et cetera, they're all acronyms, but they all have climate or sustainability in them somewhere. There's a huge amount of work being done on ESG data. There are many fatal flaws to it, I think it's safe to say at the moment. But the debate isn't over. I think we're really starting the next version of this. You just saw Sustainalytics get acquired by Morningstar, at least the latter half of it. They were already invested in it last week, I believe, which just goes to show data providers are scooping this up. No one's cracked it, kind of a Wild West. But I'd also say, some folks, you have to be, again, back to the materiality aspect. To be a true ESG investor, you really have to have your own clear perspective. It hasn't been defined for you yet, right? There's no like price to earnings ratio in ESG. You've got to go figure that out for yourself. And that's what separates the wheat from the chaff.
Thank you so much for those answers. Yeah, it's definitely kind of an ever-evolving space, and the definitions that go around it kind of determine how you see how much it's growing. So that's really exciting to hear all of your perspectives on that. Kind of going right along with that, there are a lot of questions around, do you believe that ESG analysis is creating an impact in the world? And we kind of have already heard a little bit from your answers to that last question of, it is happening and some of it goes to impact related companies, but is this new framework for analyzing companies actually making an impact? And maybe more pertinently for the MCJ community, have you seen this framework help create solutions for climate change? And have you seen it push climate change solutions forward faster?
Yeah, so
positive on this. I don't know, we should do a quick vote, like, yes.
Yes or no, is this positive?
Yeah, listen, on balance, I think it's helpful, right? More companies acting better, Microsoft just saying we're not going to just be climate neutral, we're going to go climate, we're going to be carbon negative, right? And we're going to take back climate that we put out 30 years ago. Like, that's all sort of positive. That goes back to my first comment around, creating this stakeholder approach to running your company ultimately generates, it's causing other companies to do it, right? BP put out a climate neutral concept, but it's not very well defined. Shell has followed, and Exxon and Chevron are nowhere to be seen. So I think those kind of one-upmanship, kind of help broadly. But the other point I would make, I kind of alluded to earlier, is there's this concept of additionality, right? And so if I decide that Ørsted is a great company for the climate, or I decide Microsoft is a better operator of compute than Oracle, and so from a climate perspective, I'm going to buy one, not the other. I don't really create, if I buy a share of Vestas or Ørsted, I don't create a new wind farm, right? I'm benefiting from the wind farm creation, but I don't really add to it. And that's why, one of my key points in all this, despite the fact that I'm a public equity guy, I actually would love to work more in venture and private, because that's where the additionality is happening. So if you invent a new technology that pulls carbon out of the air, or you modernize, how electricity is delivered, and you take out 20% of the waste in the system, that's positive. And so creating these new technologies, we need those climate leaders, and we're just not inventing them. So that to me is the most exciting thing about all this, is that we're seeing all this new interest in venture capital coming into the space, and that creates that additionality.
Yeah, we're definitely seeing the public market interest create pull for some of our later stage companies. So we're mid to late stage venture capital. We're mid to late stage venture capital firm, and so several of our companies are contemplating an IPO in the next, say, 3 years or so. And so it is exciting for us to see this, because I think it points to a more positive reception for stocks like this in the public markets. The other piece is, I think there are more crossover investors. So some investors like Coatue, who do both public and private investing, are starting to look more at putting in capital into private clean tech companies, which is good for the whole sector, because as we all know, clean tech companies tend to need more capital for longer. And then on the very, very early stage, I think it is creating the incredible momentum that Tesla and Enphase and all these very clean tech like stocks have been having in the last 6 months have really created a lot of early stage interest as well. So to Daniel's point, like more innovation can only help advance the climate change mitigation.
I totally agree. And one anecdote to kind of add to that, even on the public side, is many moons ago, there were large fossil fuel divestment rallies on many campuses across the US and internationally. That's when I was wrapping my head around shifting from a policy lens to more of a financial lens of how I personally wanted to address climate change. Was running a student-led fund, like a couple $100K, and got tapped to help the Brown Endowment think through how the $3 billion, now $4 billion portfolio could integrate climate. And so, quick primer, most endowments are externally managed, which means that they're not sitting and choosing as investment professionals their direct stock portfolio, right? That's outsourced to experts in lots of different niches, and you're trying to balance all of those experts, so you've got an awesome allocation. Really high level primer, but helpful, because I didn't know that when I first got to the endowment. And so the positive of that is you can have best in class relationships and hold those for a really long time and get those best in class returns. Potential negative side is you're inherently at a distance. You're letting an expert take your money and do what they think the expert thing to do with it is, which means you can't just snap your fingers and divest from fossil fuels, for example, because you don't know where at any point in time all of your assets are. So when we were thinking about what does ESG at a $4 billion portfolio look like, that mostly looked like education. And so education as much as we possibly could while still having an appropriate relationship with our fund managers, education around how we thought of ESG, how the market thought of ESG, what were our most important parameters, what were their most important parameters for their portfolio. You got to bet that looks very different across a whole bunch of different asset classes. And so that was closer to like 8 years ago or something at this point. And so the conversation has evolved dramatically since then. And that is not just because we were having those conversations, it's because the whole market was starting to ask those same questions about ESG at the same time. So pulling it back to your original question, Eli, right? Like, has this had positive effect? Sure, there's greenwashing, but I think overall, continuing to hold asset managers to a standard that's ratcheting up year over year, we're having really positive momentum there.
It's very uplifting to hear you all kind of have this very positive opinion of, yes, there's definitely things that people are calling ESG investing that may not be promoting impact first, but there also is a lot of things that are moving forward, and slowly and surely we're kind of seeing this progress over time. I think one thing that you all have talked about is everyone has to create their own portfolio thesis for themselves and has to decide for themselves what it means to have ESG analysis. A lot of people had different questions about how you think about those things, and I think we could have a whole panel just on each of your ways of approaching it. But to dive into one of the more specific things that people have brought up, there's kind of this balance between profit and impact. Somebody put it pretty bluntly when in one of their questions they said, are profits or purpose more important to you? Which I think everyone will have nuanced answers to that, but would love to hear how you all think about the trade-off between seeking positive impact and positive returns.
So my view is there's absolutely no trade-off. In fact, it's actually quite the opposite, right? The companies that are not aligning for the future are going to underperform. The companies that don't attract talent, that don't invest in their community, that don't invest in their product, and aren't cognizant of the environment around them are going to underperform. And that data has borne out over the years, right? And so whether that's, a tech company sticking to a licensing model where they sue their customers to one that's going, and that's scalable and moves with the number of subscribers that they have, to an extractive oil company versus one that's creating renewable energies, right? So I think that if you don't take that stakeholder approach, you will underperform. So there's absolutely no trade-off. In fact, it's the inverse. There's a positive correlation between creating a company with purpose and profits.
Yeah, we definitely feel similarly. I think longer term investors would all align with that. Like, we have a 10-year fund. For us, at different points, different aspects of ESG matter more than others. So governance always matters, but some of the aspects of S, so for example, when at the point at which we invest in a company, they might be quite early and might not have built out the diversity in their team that they need, or the diversity in their board that they need. And so that doesn't become a blocking factor. It just becomes a point of discussion and something that will work with the company to develop a plan for over time. So I think in the near term, investors may not see a difference, or may see a trade-off depending on what stock they're betting on. But I think if you are investing for the long term, all aspects of ESG do matter to prepare for and to build resiliency and build good processes through a company.
I think what Monica said is extremely astute, and you hit all of my points. That's the risk of going third here, but echo the long-term aspect. I think it's almost 100% correlation, because you're minimizing all of these inherent risks along the way. In the shorter term, I've thought a lot recently about kind of from an economic perspective, why on earth would some of these large companies impose almost a self-tax, right? From a let's go carbon neutral, let's go carbon negative. It's inherently a self-tax that they've imposed on themselves. Why would they do that? There's some really interesting work out this week from a great team at BCG. I hate to rep I'm from Bain, so I hate to rep the other side, but my friends at BCG have put out a great piece, and it's part of a series on carbon offsets, and more broadly, I think it'll probably go into willingness to pay a little bit. And I don't want to preempt what they're going to be publishing, but these are self-taxes that the companies are putting on, and yet they see a return from a talent perspective and from a brand perspective, which for those companies that have high margin products and a low carbon intensity to production, makes an awful lot of sense to go out and be a leader in this, when the market will reward you with outstanding intellectual talent and loyalty, as well as brand loyalty that goes along with it. So starting to rather than just saying it's good or it's bad or it's the right thing to do, really start to quantify it and almost think about it as like another willingness to pay. I think will kind of be where the market shifts to.
I think we have time for one more question, and then we'll probably start going into breakout rooms. So this was both a question that a lot of people submitted, but is also, I think, one of the most common things I see brought up in the MCJ Slack in general. But how do you all think about both the availability and the quality of ESG data that's already out there? And from my own personal perspective, I've seen kind of a lot of tools emerging in that space. How do you think about ways to improve the ESG process, both for investors and also for companies that are trying to report this type of data?
So as we're running out of time, I'll go quickly, but I mean, it is getting better, right? So like, for instance, a couple people, Monica's mentioned SASB. I recently completed the Sustainable Accounting Standards Board, certification process, which took like 9 months. And that's a framework to make companies reporting on this more standardized. So it's not these sustainability reports used to be like, hey, we did a canned food drive during Thanksgiving, or like we helped build some housing for people. It's supposed to like, okay, what's actually material to your business, and report that consistently, so you can compare companies between industries, and you can compare it year to year, and that's super important. But it's not necessarily all about data, right? I mean, you look at a company like Apple, there's 50 analysts who cover the stock. There are hundreds of alternative data providers that have the credit card data of people who purchase their products, satellite data of ships coming out of China with Apple products on them. I mean, there is no company more analyzed than Apple today. And then almost every quarter, the stock's up 8 or 9% or down 8 or 9% on the print, because someone's got the expectations versus the results wrong, right? And so there's a company with virtually perfect data on their earnings and sales, and people still get it wrong. And so that's why my focus tends to be more on like, what is the company's strategy around this over the long term? And a lot of those are forward-looking concepts that even earnings data, in a report is backwards looking, right? So ESG data, and Monica alluded to this before, is, the sustainability report comes out like in June, and then these indexes are built on something that comes out in June, and they update the index in September. And so it's like a year and a half old by the time it comes out. So, even if it was real time, it's still backwards looking. So I think that, there tends to be an over focus on data and under focused on real fundamental, what is the company doing? But that's my view.
For us in private, I mean, there's basically no option for private companies. There's not like the pitch book for ESG that's emerged yet. So we end up doing it pretty manually for our portfolio. For public companies, I do think people seem to be coalescing around MSCI for now, but I am really excited. As Daniel was saying, like there are new providers emerging that are finding more creative ways of scraping visual data and purchasing data and other data sources. But then also hopefully taking that to the next step of how do you translate that data into meaningful insights. So I think I'm hopeful of how things are evolving. I do think it will take a little more of a regulatory push or civil society push around coalescing around what is material, as Sophie's mentioned a couple of times, and like how frequently we need and want that information in order for us to move from just throwing data at the problem to extracting the meaningful insights that pushes both shareholder and company action.
Echoed again, you're making my job easy over here. Quick. Trying to pull another potential anecdote. I've been thinking about how to measure the carbon intensity of very, very early stage technologies that don't necessarily really have their market set up yet, let alone operations. And just going to say that there will be a next gen of techno-economic analyses for carbon intensity that need to happen. I don't see, well, if anybody has cracked that nut, let me know. I've been having conversations with some people on this call about how to go about doing that. And it will require a whole bunch of deep technical science talent, probably a whole bunch of AI, machine learning, data scraping, data formatting talent. But if we can crack that nut of really understanding how to tie the science loops into the business loops, that's kind of the holy grail. Particularly, I would say around carbon intensity would be the one place to focus first.
Awesome. That's an amazing note to leave us on, because I think that would be something that in the breakout rooms, a lot of people are interested in. We also have a lot of really wonderful questions coming in the Slack, but I think given that we're at 3:40 already, might cut the questions off here. Just want to say a huge thank you to all of our panelists. MCJ is such an amazing community because we get these diverse perspectives, and just incredibly appreciative of all of you sharing your wisdom with all of us. So yeah, if anybody wants to add the clapping reactions or silent claps all around for these amazing panelists joining us today. Thank you so much.
Thank you for organizing, Eli.
I will shift all the gratitude to Chris, Brianna, Daniel, and Nicole for doing that. But I'm very lucky to get to be involved in this one.
And thanks to everybody for showing up on a Sunday.
Yeah, Sunday at 3 p.m. and I think at some point we had 40 people in this call, some of which are, I would say, leading experts on this topic in general. So very appreciative to everyone for being here. Okay, so with that, we're gonna start getting ready to do breakout rooms. I think Chris is gonna work his magic in the background to set that up. Just one general ground rule for the breakout rooms. This is a chance, kind of like a happy hour type setting where you can just meet each other. We try to cut down on just I think there's a Zoom tendency to just go around and introduce yourself and say what you do. So we have one general ground rule around: don't introduce yourself, don't say what you do. Instead, maybe just start going straight into the topics that you find the most interesting. They can be around ESG, but from my experience, some of my favorite conversations around climate change have been totally unrelated to the topic, but in one of these amazing breakout rooms with all these people who want to come at 3 p.m., well, at least my time, 3 p.m., and talk about climate change. So talk about whatever you like, as long as it's not the exact thing you're doing. And definitely a good chance to kind of bring up the questions that you've posted in the Slack, or any of the thought-provoking questions that have come from the panelists. So with that, we're going to get started with breakout rooms. Chris.
Hey, this is Cody. Can I break in to ask? I was curious and put a question into that Slack channel earlier. I'm curious about people's opinions about the degree to which retail investors actually drive some of the interest versus not, or I should say drive growth in ESG investing versus kind of being a passive consumer of funds marketed as ESG driven. Like, what do you see, if anything, as drivers coming from the retail investor side? Does that matter?
Yeah, so no, it does. So three things on that. One, again, is, the first comment I made at the top of the call was you shouldn't call it ESG investing, because there is no such thing, right? It's a tool to sort of, help investing. And one of the things, as interest in this has grown, is there's become sort of more scrutiny on the marketing of those products. So, for instance, BlackRock has some, again, these are passive, they're just indexes, no human beings are looking at these companies, but they had a few funds they were calling, sustainable or impact, that were actually not sustainable impact designed. They were just what they call ESG integration. They've factored these things in the process of building the index, but they're not trying to go for an outcome. And just in the last 1 or 2 weeks, BlackRock actually rebranded those things and said these are, ESG aware funds. In other words, they're not claiming that they're impact, and they just want some new, more impact focused, funds. They're trying to have an outcome. So as more people have come into the space, you get better scrutiny. So the competitive markets are working. So to your point, and consumers are a good part of that. And a little bit of a side
about driving quality
question.
There, you're saying.
Yeah, right. And the NGOs are great at this. There's a UK-based group called Share Action that went through and they actually ranked all the funds based on the sort of the climate footprint of all these funds that were claiming to be, ESG or climate related funds. And then they, and they looked at the voting records and everything. It's pretty comprehensive report called Share Action. So they've done things like that. But in terms of the absolute numbers, I have them somewhere, but the, retail, push into, these ETFs has grown. I think the unfortunate part, and again, you know, it's talking about the book, is I don't think there's enough availability of funds in the U.S. to for if you say, okay, I don't necessarily need to buy a passive index. I think actually you like to get a group of, you know, a fund manager that's thinking about the long term of these companies rather than just having, you know, an algorithm do it. And in Europe, there's quite a number of funds that do it. Here, there are fewer of them, but it's starting more and more. Some of the bigger mutual funds are launching, and then there's some specialist guys. So, you know, but in terms of how much of those assets are retail versus institutional, actually, I don't have the number on the top of my head, but it is growing.
Just want to use this chance to give a huge thank you to Jason for obviously creating this entire community. I know for me, as somebody getting into climate change, it has been so incredible to have a community of people who are interested in so many topics. And I just feel like people in the Slack are so brilliant and have such amazing perspectives that to be able to get to talk to all of you and have these breakout rooms is one of my favorite things. So just very grateful that we kind of have somebody who both created this podcast, but then put the extra effort into creating a community and allowing us all to have this shared space that even in like quarantine times, we can all get together from around the world and have these amazing discussions. So just a huge piece of gratitude to the entire MCJ community for allowing this to be created. People are getting used to those clapping reactions. I appreciate that. So we are gonna like somewhat formally close now since it's getting close to 4. A huge thank you again to everybody who helped organize this event. All these things are entirely community led, and just constantly amazed by how much effort people want to go through to make these things happen. And just a huge thank you again to the panelists for being just so amazing at answering all types of questions and being able to add their perspective in really fun and interesting ways. And then biggest thank you to everybody who came here and decided to spend an hour with us on a Sunday to all hang out and talk about an issue we all really care about. So big round of applause for everybody involved in making this happen. With